Thank you so much for joining us today. We do have a very special topic that we're going to discuss. That, as you can see during the screen here, um, it's the IRA Advantage. And I have a special guest here to share more with you about non-recourse lending, which of course is a requirement for a loan for an IRA or a 401k. And so the expert is going to share more with you on that. But before we get to him, I'm going to share a little bit about what we do here at Sense Financial in case somebody's on this call and they don't know. We are a financial, we are a boutique firm that specializes in helping people unlock their retirement accounts to be able to invest in alternative assets like real estate, crypto, precious metals, private lending, private business. The sky is almost the limit, okay? And we've been in business since 2010. Our plans all have what's called checkbook control, which allows you to efficiently invest by bypassing the custodian and not having transaction fees and red tape that goes along without having checkbook control. And we've also have hundreds of five-star reviews all over the place from clients of ours who have trusted us to create a plan. We don't hold their money. We're providing the vehicle and they're investing using the IRA or 401k that we provide them, but we don't hold any of their money or their assets. But they've trusted us to partner up in that sense to provide that plan to them so they can have a truly self-directed, diversified type of portfolio outside of just Wall Street. And we've assisted over 7,000 clients to date, and we have set up over 8,000 self-directed plans for them. And most of our clients come from referrals, and most of those referrals come from our existing clients. So what are the benefits of a self-directed IRA or solo 401k? Well, they allow you, as I just mentioned, to have true diversification. The investment returns can be either tax deferred in a pre-tax traditional environment, or they can be tax-free in a Roth. And that could be with the 401k or the IRA. And we're going to talk about non-recourse financing here today, but you can leverage the cash you have inside of your plan, get a non-recourse loan with somewhere between 30 and 50% down typically, and buy more real estate with that money than your plan would otherwise be able to afford. So your return on your investment can go through the roof in some cases because you're using OPM, right? Other people's money. And you could, and I'm not sure if our guest here is going to talk about this today or not, but you can refi as well using non-recourse lending. It's a little trickier because of the rules with non-recourse loans and such, so the numbers don't always make sense, but you can refi. In some cases, you can even take money out to use for an investment. And then the solo 401k is, of course, we call it the ultimate retirement plan. It is a true tax shelter. In 2026, you can contribute up to $77,500 if you're over 50 years old, $72,000 if you're under 50. And we talked about the different investment options there are and the true diversification, which, by the way, is biblical wisdom as well as just plain wisdom. Ecclesiastes 11:2 says, divide your portion to 7 or 8. And because you do not know what misfortune may occur on the earth, and that's true, we have no idea. There's crazy stuff going on in the world today, and although the S&P 500 is done pretty well lately, anything could happen. We'll see. But if you want to avoid a lot of the downside of investing in just the stock market, which is what I mean by downside. I mean the downs and the ups and the roller coaster. Then you can truly diversify by investing in assets that you know, control, and understand, like real estate, for example, where two people are signing on the dotted line about the terms, what the payment looks like, what the ROI is going to be if it's a private loan, for example, what the interest rate is and what the terms look like. Is it 6 months? Is it 30 years? Is it interest only? Is it not? Is it fully amortized? All that stuff you control because it's truly, quote unquote, self-directed. Okay, that's what we do here at Sense Financial. If you're interested in having a conversation, visit our website, SenseFinancial.com/consultation. We'll do a free private call and see if it makes sense for you to become a client or just answer your questions. No hard selling, just pure education, which is what we're here to do today. And With that, I am going to introduce our keynote speaker. His name is Mark Robbins, and Mark is nationally recognized as an expert in non-recourse financing for self-directed IRA real estate investors and has been helping investors secure these specialized loans for over 20 years. He's worked with clients in more than 30 states, is a trusted resource for many of the leading IRA custodians in the industry. And with a background in law, mortgage banking, real estate investing, and entrepreneurship, Mark brings a tremendous depth of real world experience to today's discussion. And please join me in welcoming Mark. But before we do that, I just want to call out Mark was kind enough to send me this REI, Real Estate Investing Wealth magazine, where he has a full layout towards the end starting on page 65 about what we're going to talk here today. So Mark, I'm looking forward to reading this. Thank you so much for sending that to me. And with that said, I am out of the way, my friend, and you can take it away. Mark's having some trouble with his camera, unfortunately, so you may not be able to see him unless that magically fixes itself, but you're going to be able to hear him and you're going to be able to see his presentation.
Well, thank you, Brett. I'm listening to your melodious voice. I appreciate the introduction, and I'll try to live up to some of that. I started Lending Resources Group back in 2007 after my first stint into the residential mortgage banking arena, which I got started working for Bank of America. And then my boss happened to move over to a company called Centex, which stands for Central Texas, one of the largest home building companies in the United States. And they had a division called CTX Mortgage. And I'll take you to my next screen. That's a little bit of my background. And cut my teeth on the mortgage, residential mortgage business. I knew a number of people in that business doing well. I was kind of forced to reinvent myself from my prior career, which was the ownership of an executive recruiting firm, placing software people, and that's a whole different story. I don't want to take everybody's time on that, but suffice to say, I think my career has shown I have a tolerance of about 10 years doing the same thing, and then I need to move on. Even with the mortgage business, I've been doing commercial now. It's probably the longest stint I've had in any endeavor, being doing mortgages since 2002. But again, I really left the residential part behind when I started Lending Resources Group and gravitated into doing commercial financing. But that's where my emphasis has been, and it's been very exciting. And within that, I developed this niche of non-recourse lending for IRA investors or investors that have money in trusts or converting 401ks from their employment, and how to do that in real estate. So you can see my background a little bit there. I spent about 10 years in the commodity markets, even before my search business, moved on to mortgage lending, and I'll get into the non-recourse aspect. And just to piggyback what Brett said, whether you're buying or refinancing, the parameters for the loan is pretty much the same. So it's really not any trickier to refinance than to purchase. So we'll get into the parameters of that. So I'll move on. Also, just to say that I am licensed by the Department of what they used to be called the Department of Corporations, is now the Department of Innovation and Protection. And they issue a license called the California Finance Lender License. So CFLL, that's where my you could say my degree or my license is. Next screen, onward and upward. So, we're talking about the advantages of investing retirement dollars into real estate. And, here you've got, a number of nice bullets. Effectively, you've got rental revenue is tax deferred. You've got property appreciation, tax deferred. You got forced savings. So, in other words, when you buy something, you have to put down more money. Well, that's kind of a twofold reason. It protects the lender, number one, because the lender is lending money without your personal guarantee. And it also encourages the investor to create from day one a higher point of equity in the property that you're buying. And of course, that ends up giving you a lower mortgage amount. So you've got lower monthly payments. It all works in your favor. And we'll get into the tax aspects of it. That's probably one of, if not the biggest advantage to investing your retirement dollars in real estate.
Real quick, Mark, and everybody else listening, please type in your questions. We will give time at the end for Q&A. And then I know some of you, I forgot to say this at the beginning, my apologies, did submit a few questions ahead of time. I will make sure that we get to those as well, okay? And we'll start with those, and then we'll move to the live questions. So don't save
Yeah.
them. Don't try to remember. Just type it in now, and we'll get to it when we can, all right?
Yeah, I'm happy to answer any and all questions as best as I can, of course. And if I don't know the answer, I'll let you know. But I've done this for a while, so hopefully I should have most of the answers. So, what are the loan requirements? Everyone's asking that. The lenders out there. So let me first start out by saying that the IRS requires by law that you not personally guarantee the loan. Hence, that being the description of non-recourse as opposed to recourse. So, in other words, whoever lends you the money has no recourse to come after you if you default. The only recourse they have is to take the property from you and also have access to any rental income that the property generates. And why do you think that is? Why do they make that a rule where the IRS says you can't personally guarantee? Simple reason. The money you're using to invest in the real estate has not been taxed yet. And the IRS doesn't want you playing around with their money, hence non-recourse. So they make it so if you're going to use a portion of their money to invest in real estate, you cannot personally guarantee the loan. And the banks that do the non-recourse loan, that issue the non-recourse loans, they follow suit on that. So, I was in the conventional mortgage business for about 6 years before I got started with Lending Resources Group. And when it comes to requirements to qualify for a regular mortgage, there are just a lot more requirements, like providing tax returns. Now, you don't always have to provide tax returns, but more often than not, you do. In addition to that, you got to have a certain credit score. Everybody knows that in order to qualify for a good interest rate and a good loan to value. You have to have copies of asset statements. There are a lot more requirements for conventional mortgages than there are for non-recourse loans. When it comes to non-recourse loans, really you only have to show your asset statement of your actual retirement account that you're using for the down payment and the reserves, and there are the reserve requirements. And the other most important requirement, besides having enough money for the down payment, is that the debt ratio, meaning the income of the property, needs to exceed the monthly debts of the property by at least 20%. Some lenders require 25%. So, in other words, very simply stated, if your income on the property is $2,000 a month, then that needs to be at least 1.2 times what your debt on the property is. And the debt that they look at consists of mortgage payment, and that's principal and interest, taxes, insurance. If there's a management involved, then the management fee, then that could be anywhere between 8 and 10%. And yeah, they don't usually count utilities, although they kind of look at those depending upon how the cash flow is. But sufficient funds for closing. And when it comes to down payments, the majority of loans require 40% down. I have access to a couple lenders that will go as high or allow as little as 30% down. So there are a couple lenders out there that'll consider on a case by case basis a loan of 70%, but more often than not, it is 60. It's hard to get around the 60. And hopefully, that explains a number of things, but you may have questions about that. So we'll definitely address those at the end. And of course, the property needs to be rentable. And they do look at population stats, where the property is. And, the tougher properties to get financed are the ones out in the boondocks, so to speak, country type properties. I've done them, but they can be a little tricky in that regards. And VRBOs, yeah, Airbnbs, we do those as well. Uh, Lenders used to steer clear of them, but it's become more in vogue because it's become a very popular way to rent out properties. So here on your screen, you'll see the non-recourse loan property requirements, and pretty straightforward. They like properties, of course, that at least have a decent square footage, 700 or more, and a 700 square foot property. Believe it or not, I used to own one myself. Living room, kitchen, even had a balcony, and it was about 700 square feet. I already mentioned about the populated areas. The more populated, obviously, the more guaranteed the property is going to be rented. And they generally like longer term rentals because that gives the lender more security and more assurance that the income is going to be forthcoming. So that's where they do question. They want to see proof of, when it comes to Airbnb and VRBO rental incomes. Oftentimes, the lender is asking for what's the profit and loss statements for the prior year or 2 years. Most lenders will lend, of course, for SFRs, single-family residences. I've done non-recourse loans, as Brett had mentioned, since 2004, when the first non-recourse loan program was initiated by North American Savings Bank. I'm not concerned about revealing that because everybody knows NASB, and they kind of invented the program, and I was introduced to them through the chairman of the board of Pensco Trust, which was $1 billion and is still $1 billion plus custodian. They at the time were based out of San Francisco, and then they probably about 15 years ago moved to Denver and became Pacific Premier Trust. Effectively, I connected with NASB in 2004 when they first started the program, and I think I closed my first loan in 2005, about a year later, and I've done hundreds of them since. Been a long time. Hard to believe it's 20 years though. I've done apartment buildings in as many as 32 units. I've done many duplexes, fourplexes, even fiveplexes. And there are a lot of different, uh, shall we say, in property investments that one would like to get that are kind of outside the box, like, can I invest in cannabis properties? The answer to that is yes, I've done them. Can I invest in RV parks and campgrounds? The answer to that is yes, I've done those. But they're few and far between. Those are the tougher ones to do. If you talk about tricky, that's tricky. And And there we have the percentages. Like I said, the percentage of loan to value, the standard is 60%. And sometimes even the 60% lenders will make an exception and go to 65, usually not 70, but there are lenders, maybe one or two, that will consider 70. And onward and up. Okay, so you see the title on the screen. Excuse me. I had to, I'm kind of a film buff, and one of my favorite sayings is from a Western called The Treasure of the Sierra Madre. And it's when two different sets of robbers, the cowboy robbers, come up against the Mexican bandito robbers. And the Mexican bandito robbers claim that they are officials of the government, that they're police. And the cowboy robbers say, well, the Mexican robbers say, hand over your money. And the cowboy robbers say, show me your badges. And the person that's the head of the Mexican group says, we don't need no stinking badges. So I use that to say that, in a way, I mean, nobody likes to pay taxes. We all have to pay taxes, and you only have to pay the taxes that you legally owe, as stated by a Supreme Court justice way back when. But the benefit of owning real estate with your IRA has two-prong effect tax-wise. One being the UBIT, unrealized business income tax, and that pertains to the monthly/annual rental income of the property. And then the unrealized debt financing, that is realized when you sell the property. And the next screen will show examples of that, and I'll discuss that. So when it comes to the monthly income, and I don't like to necessarily read off the screen, I really much more comfortable just as if I was speaking to each and every one of you individually over the phone. So when it comes to the income, the first $1,000 of income is tax free. You're not paying tax on the first 1,000 of income. And that's the first 1,000 of income profit after you've deducted all of your expenses. Okay. After that, if you have more profit above and beyond the first $1,000, again, after you've deducted all of your expenses, then the percentage of ownership is the same percentage of profit that goes back to your IRA tax deferred. At some point in time in your life, when you start taking money out of the property to live on, if you do that, then you're going to pay tax on it. But until then, it's tax deferred. Let's just say an easy example, 50-50. You own the property 50%, you financed 50% of the property. Okay, 50% of that profit, again, if your profit was for the, let's just say for the year was $6,000, and the first 1,000 is not taxed, then you have 5,000 that is subject to tax. 50% of that 5,000, $2,500 goes back to your IRA without being taxed, and then you're going to pay, excuse me, a trust tax on the remaining 2,500, which is about 17%. So all in all, if we net the figures out, 17% of 2,500, well, that's going to be somewhere in the neighborhood of a little under $500. And, so if you look at your profit being 5,000 and you're only paying a little bit under $500 for the tax, that's a pretty good ratio and a pretty good benefit of owning real estate with your retirement money. And see if I covered that okay. Again, I didn't read it because I'm more comfortable explaining it as if we're just having a conversation. And I think I covered that base. I used 5,000 as an example instead of 1,000. And again, any questions on that, we'll cover that at the end. Now, the UDFI unrealized net financing income, the same principle pertains. So if you sell the property, let's say you own the property for 10 years, you sell the property and you make a profit of, let's just, easy reference, $100,000. Well, if you've owned it for 10 years, you've probably paid down some of the principal. So I would say in an example that let's just say that you own, instead of owning 50% of the property, by the end of 10 years, you own 70% of the property. So 70% of that profit of 70% of 100,000, that'd be 70,000, would go back to your IRA tax deferred. The remaining 30,000 would be taxed at the capital gain rate, whatever that is at that time in our economic cycle. And it's usually somewhere around 15 or 20%, let's just say 20%. So you'd pay 20% in tax on that 30,000. So you'd end up paying $6,000 on a profit of $100,000. That's pretty good. If it was conventional, then whatever your tax rate is, and let's just say, a lot of people's tax rate tends to be in the 20 to 25% range. So you'd be paying, on average, maybe 25% of that $100,000 profit. That's $25,000. So you'd be paying 4 times the amount of money in taxes if it was conventionally owned real estate, conventional money. Okay, I think I covered that. And next screen, there's my contact information. So my email, my phone number, my website. You can find me on my website, reference me on that, and my official license number. Want to verify me with the state? I welcome everybody to do that. And hopefully I've covered the bases and raised any questions that you may have. I'll be happy to answer.
We do have some questions, and great job, Mark. Thank you very much. Appreciate
Thank
it.
you.
I'm going to read the pre-submitted questions first, and then we'll get into the chat here. So
Yes.
Sood here is asking, what are efficient ways to invest? Some of these I may just take, Mark, so bear with me here. What are efficient ways to invest from self-directed IRA with respect to tax savings? What financial products are recommended, like life insurance, annuities, etc., for a 51-year-old person or older to take advantage of self-directed IRA funds? Well, Sudhir, so just a general statement here. Neither Mark nor I are financial planners. We don't even play one on the internet. We're also not attorneys or CPAs. Mark has a law background, but we're not here talking about law per se.
Yeah, I'm decreed attorney, but I'm not. I'm not decreed
There you
by
go.
the
Okay,
state.
perfect. So that said, Sudhir, I'm an expert on the checkbook self-directed IRA and solo 401k. Mark is an expert in non-recourse financing, which obviously is a requirement of self-directed IRAs and solo 401ks with or without checkbook control. So he has a knowledge about both of those things, more so than I do on the non-recourse side, of course. However, life insurance, no, that's not a go with the self-directed IRA. That's a totally different product. Annuities, you're not going to come to a company like ours and want to invest in either one of those things. Most of our clients are looking to invest in alternative assets like real estate, precious metals, crypto. If you want to set up an IUL or some other type of whole life insurance or annuity product, I can refer you to somebody, but that's not Mark nor I are going to help you with that. So tax efficient way, tax savings. I mean, it's either tax deferred in a traditional IRA or 401k, or it's tax free in a Roth. The only time there's going to be a tax implication is what we're talking about here with the non-recourse loan scenario, or if the IRA or 401k actually owns an active business, like flipping a ton of real estate, for example. That's not a passive activity, that's active. That income is also going to be subject to a UBIT tax with or without financing involved. Okay, so there's two ways that the UBIT can be triggered. One is with the financing in an IRA only, and or conducting active business in either the 401k or an IRA. And I put in the chat the solo 401k, if you're qualified for it, self-employed with no full-time employees, and you set up a solo 401k, that is exempt. The 401k is from unrelated business income tax on leveraged real estate only. It still can pay it on that active business stuff I was talking about, but not on leveraged real estate. Okay, so I wanted to make sure I mentioned that. Mark, anything to add on that question?
Yeah, I'd like to make a plug on behalf of Sense Financial and Brett and his team. A lot of people ask me, well, do you know custodians? What do you recommend I do? And frankly, I never like to have to ask my parents for permission to do something. And the checkbook control gives you the ability to manage your money without violating any rules of the trade, so to speak. If you have a custodian handling your funds, every time you need to pay a bill or you wire money or write a check, you have to ask them to do it and you have to pay for it. If you have a checkbook control, you have a checkbook LLC, you just take your checkbook out and you write a check for whatever you need to. And so, in my opinion, that's the way to go, bar none. I think that, their service is very, very valuable and you've got the power over the funds legally by having that checkbook LLC and checkbook control. So I want to say that, and Sense Financial does a great job on that.
Thank you, sir. The next question from Romel, and this depends on what kind of real estate you're talking about, Romel, because obviously there's more than one ways to invest in quote unquote real estate. But we're here today to talk about non-recourse lending for real estate. So I'll let Mark take this question. Romel's asking, what is the IRA or 401k for that matter minimum amount needed to invest in real estate?
Well, that question kind of begs another question: is what's the minimum loan amount that you can get from a lender? And lenders, there's the same amount of work for a $50,000 loan as there is for a $500,000 loan. Same amount of work. You still need a title report. You still need an appraisal. You still need asset statements. You still need and sometimes a property survey. So when it comes to minimums, I mean, you have to look at what's the property cost. And nowadays, I mean, 15 years ago, if you remember the crash of '08, there were a lot of properties available under $100,000. And if I mean, I did loans for people as low as $30,000, $40,000, and they were buying something for 70 or 80,000. I mean, I think those days are pretty much long gone. So it also, you have to look at, well, what can you buy that's available? But if you're asking what's the minimum that you need, if you take the standard 40% minimum down payment requirement, 40% of, with let's say a minimum loan amount permitted of 40,000, let's just use 40 as the number, because that's pretty much what lenders, that's their watermark. They don't like to do the work for much less than 40,000 as a loan amount. Then you're looking at 40% of, so you get a $100,000 property, you got to put down 40, and hopefully you have enough to meet the reserve requirements. Let me mention the reserve requirements. I didn't really speak much on that. Some lenders require 15% of the loan amount in reserves, and others only require 6 months of principal, interest, taxes, and insurance. So let's just take a $100,000 property. You put down 40, you got a loan amount of 60, 15% of 60 is about 9. So you need 9,000 in reserves, and your closing costs are probably going to run on a $60,000 loan, somewhere in the range of, with loan fee from the bank, broker fee from me, title insurance, property insurance. Taxes are always due when you buy property. You're probably still looking at closing costs in the $6,000 to $8,000 range. So you should have 40 plus 15 is 55, plus let's just say 7, 62,000, 63,000. You should have at least that much in your retirement account if you want to buy a property for 100 grand.
There you go. So Romel, you can apply that math to a higher valued property or higher priced property, but that's a great answer. Thank you, Mark. And then Dana is asking, are these recorded? Yes, they are. If you registered, you'll get it automatically. Ray is asking, um, need to understand non-recourse loans, pros and cons. I think we did a pretty good job of covering that. Did you want to add anything on
I
that?
can reiterate a little bit. I mean,
Okay.
the major, let's just say the major pros are the tax advantages that I went over for both the annual income of the property and the long-term capital gain of the property if you sell it. Most of the profit is going to be tax deferred. When you get right down to doing the math, you're ending up with maybe having to pay a net out of pocket of 5 to 10% of your profit if you're invested in your retirement money invested in real estate. Versus conventionally, you're going to pay whatever your tax basis is on the profit that you have after you've deducted your expenses. And then the qualifying, you don't need a certain credit score. I mean, they do check your credit, but only to make sure you don't have any bankruptcies or foreclosures. Other than that, I mean, if you have a bad credit, they're going to want to know. I'm being interrupted. You could give me 5 minutes.
No problem. I'll keep going. Just mute yourself, please, Mark.
I've got a granddaughter that he's attending to for
No worries.
5 minutes. I'll be right back.
You're good. All right. So the next question, Sean is asking how to fill out the yearly tax form. So Sean, thank you for the question. As I mentioned, we're not CPAs, so we don't get involved in the taxes per se. The form you would fill out is called a 990T tax return, and that is going to be um, the tax form you fill out indicating what's owed, and then the IRA would end up paying that tax. Okay, Solo 401k uses the same form, but again, only when there's UBIT, unrelated business income tax that's generated from an active business. Since again, I'm reiterating this because the Solo 401k is the ultimate retirement plan, it is exempt from the UBIT on leveraged real estate. Okay. So if you're self employed, we should talk about that if you want to invest in real estate with leverage. All right, moving to the chat. SJ is asking, how are UBIT and UDFI taxes applicable in cases of SDR investment in real estate? I think we covered that. I don't have anything else to add on that question. Ruben is asking, does Mr. Robbins um, do the funding for non-recourse or facilitator? Typing too fast. Um, he is a broker. Okay, so he's not a funder. He's not an underwriter, though he knows enough to probably do all of that, especially the underwriting portion, because he's taking the loan application and crunching the numbers and all that. But he doesn't sit in either one of those seats technically. He's the loan broker. So he goes to pretty much any non-recourse lender that's out there, Mark can use. In fact, I'll plug him back. I've sent a bunch of people his way, and they profusely thank me because some of them, prior to talking to Mark, were going down the list and calling all these different lenders, and it's a lot of work. You have to re-explain your situation over and over and over again. Well, you just explain it once to Mark, and then he goes to work for you. He's the one-stop shop, in my opinion, of getting a non-recourse loan. And then Mina is asking why the need to pay tax within an IRA account. Well, Mark mentioned that a little bit during the presentation. I think your question may have come in after before he said it, but a few reasons. One, you are well, really, here's the answer. This is my humble opinion. The IRS is okay with you using leverage on real estate, but you're not using all the IRA money. So to kind of mitigate that benefit, sort of, for lack of a better term. The IRS says, okay, you can get a loan, but since it's not just IRA money, you're getting a loan as well. The IRA is gonna pay a little bit of tax because of that. So that's my humble opinion. I don't know if that's accurate or not. Uh, why the solo 401k is exempt and the IRA is not, I don't know. Probably just needs an act of Congress to change that. There's a few things that could be changed that don't make sense regarding self-directed accounts and rollovers and such. Another one is Roth IRA cannot move into a 401k. Once it's a Roth IRA, it's always a Roth IRA.
I'm back, by the way.
Okay. So the only way to self-direct the Roth IRA is with a self-directed Roth IRA. So that's one of them. The other one is UBIT with an IRA and not with a 401k. I don't know. Congress needs to change that. Maybe they will, maybe they won't. Write your senator, write your congressman, and see. And then the last question here for now is Jose is asking, what are the rates, points, and approximate costs for non-recourse financing?
Great question. Finally, somebody has get when the rubber meets the road. So I can tell you that from the time I started 20 years ago, the rates have not changed that much. If anything, they've gone up. 20 years ago, we're probably looking somewhere in the 6%, 6 to 7 in that range. But also the rates are dictated by which program you're going to take. So you're going to have a different rate for a 5-year fixed than a 10-year fixed, or a 10-year fixed to a 25 or a 30-year fixed. So I can tell you the range from low to high on a 5-year right now, we could probably get a 5-year for about 6.25. 7.25, not 6.25, 7.25. And it also depends on the lender because the rates do vary among lenders a little bit. They're pretty similar because the lenders pretty much know their own competition, so they're going to try to stay in that range that's somebody else's as well. But on the low end, you're probably looking at about 7.25 for a 5-year amortized for 20 or 30 years. And on a 30-year fixed, the 30-year fixed is as high as 9 sometimes. And again, it depends on the lender. I'm going to give you an example. I have a client buying a $1 million property on Cape Cod, and he's also an experienced contractor, and he's going to renovate the property. So I got him a construction loan that's going to help him do the renovations. He's got about $600,000 in renovations. I got him a $750,000 non-recourse loan. He's putting down $1 million to buy the property. He's getting $750 through me, through my lender, and he's going to pay 9.75% interest only for that $750. And when he's finished and it's fully renovated, the loan will convert to a permanent loan, 30-year fixed at 7.375, which is
That's great.
as low a rate for a 30-year as you will find anywhere. So that lender's got a great program when it comes to fix and flip or fix and hold. The nice thing about it, it's a one-time close. So you don't have to go through 2 different closings, one for construction and one for permanent financing. So there you have it. Really attractive interest rate for a 30-year fixed.
What about points, Mark?
Oh yeah, points. I have to see what a loan amount we're dealing with. So my points usually are 1 to 2, depends on the loan amount. The higher the loan amount, the less my points. I might only charge 1 point for a loan of $1 million. I might charge 2 points for a loan of 300. It depends on the situation, how much work might be anticipated to be involved. On the construction to perm loan that I just gave you as an example, the loan is $750 and my fee is 2 points. That's 15,000.
How about closing costs?
And I might mention that the lender is usually 1 to 1.5 points.
Okay.
Closing costs would include, whatever the title insurance is gonna cost. There's a notary involved, property taxes are involved, um, property insurance. Oftentimes they'll want to impound. Almost every lender requires an impound of property taxes. Some lenders require impounds for property insurance, some don't. So the property insurance is, that you could pay that on your own or you could pay it in escrow. It depends, and those are all various amounts depending on the value of the property
That's right. That's right.
and the purchase price if you're buying it or the value of the property if you're refinancing.
Yeah. Yeah. And as part of your due diligence, Jose, and anybody else wondering, you could certainly get a sample kind of closing net sheet. We used to call it a HUD one back in the day, but that's not what it's called anymore. A closing statement, if you will. And title company or escrow company, if there is one, or even Mark can kind of help you with those numbers. If you're looking at a specific property, that's the best way to do it. So
Sure.
yeah. All right, Mark. Well, you have the last word, my friend. We don't have any more questions. That was the last one. I plugged you and your services quite a bit while you were taking care of what you had to take care of. So I got that out of the
Well, I
way.
appreciate it. Sorry for the interruption. I was blessed with a newborn grandchild about a year ago,
Ah,
and we just happen to have her right now as kind of babysitting, and my wife needed some help getting her into the car. So uh, she's the love of my life right now. This beautiful young baby girl, and when my baby girl needs help, everything else takes a back seat.
there you go. There you go.
Yeah. So happy to help anybody if you want to go over the math on any particular deal. Happy to crunch the numbers with you, go through the debt ratio requirements or the down payment requirements. Happy to try to get lenders to make an exception for your particular deal. I've been able to do some things for clients that they couldn't otherwise do themselves if they were just going direct to the lender. And that's part of the business. I understand I compete. I don't not only compete with other brokers, um, although I don't know that there are too many other brokers out there, but certainly I'm competing with other lenders, and I'm also competing with my own clients because they're out there wanting to shop around. Little do they know that there's really not that much difference, but trying to get a hold of the powers to be for specific lenders, sometimes that could be challenging. I'm reachable 24/7, 7 days a week. Lenders, they're 9 to 5 and closed on weekends. So
There you go.
I get a lot done for people that really need the help and they want to close fast. They have special, there always seems to be special situations involving real estate. So part of and having a broker as an advocate in your corner for what you need, that has some value to it. So it depends on your situation, but I'm happy to discuss whatever you bring to the table. Thank you, Brett. Much obliged. Yeah. Everybody have a great weekend. Thanks for your attention and your participation. You too. Bye.